Namaste, welcome to Arthaniti, where we discuss money and money matters to help you in your investing decisions. Looking at the current market situation, a proverb comes to mind. When the game is paused, it is time to strategize. How true, isn't it? Especially in the world of investing, where the markets are seeing significant turbulence, but they also present opportunities for those who are well prepared. As per suggestion of one of our viewers, today we are analyzing KEI Industries. Now, KEI Industries is a stalwart in the cables and wires business since 1968. It is famous amongst investors as well, but a new entrant is set to enter the arena. Ultratech Cement, with its deep pockets and a track record of disrupting existing markets, is set to enter the cables and wires industry. Following the announcement by Birlas, the question on every investor's mind is, will Ultratech disrupt the cables and wires business in the same way as it did in the paints industry? How will established players like KEI, Polycab, Havels react to this new threat? After all, in the jungle of competition, like in nature, it is always survival of the fittest. Does KEI have the strength and the strategy to not just survive but thrive in this evolving market? Let us dive deep into the company fundamentals, its financial performance to find out. Before we go on to analyze the fundamentals and financials of KEI Industries, a little backstory about the company. Now, the company was established in 1968 by D.N. Gupta with just 1 lakh rupee capital. It started as Krishna Electrical Industries, making rubber insulated house wires. Fast forward to today, KEI is one of India's leading cable manufacturers with diverse product portfolio ranging from power cables, house wires, and even stainless steel wires. The company went public in 1992 and has steadily expanded its manufacturing facilities. Today, it has plants across India's in Bhiwandi, Silvassa, and other locations. From humble beginnings of selling wires in the Delhi market, the company today has grown into a global exporter, exporting to more than 60 countries. What does the cable and wire industry in India look like? Well, the industry is booming. In 2024, the industry was valued at 9.32 billion. It is set to reach 17.08 billion by 2032, growing at a CAGR of a good 7.94%. Some of the factors which are aiding this growth, firstly, the Make in India initiative of Government of India, then the massive infrastructural development that is underway in the country, expansion of power transmission networks, rising demand for real estate and construction. These are some of the factors which are helping a boom in this sector. Now, if you see the market dynamics, of the total cable and wires market, Polycab holds an 18.1% share, followed by KEI Industries at 8.5%, Havels at 7.9%, RR Cables at 5.2%, Finolex at 5.9%. Unorganized sector in this category stands at a good 26%. While the industry is shifting from unorganized to organized sector, the entry of new entrants like Ultratech has a massive scope for growth in this category. Looking at the latest quarter results of KEI Industries, the results have shown a strong growth. Its revenue was up nearly 20% year on year basis to reach at 2,467 crore rupees. Net profit increased 9.5% year on year basis to reach 165 crore rupees. If you compare it with previous quarter, in September 2024 quarter, the profit was booked at 155. In June quarter, it was 150. So gradually there has been an increase in the profit if you compare it with the previous quarters of this financial year. Looking at the fundamental factors, the PE ratio stands at 42.63 in comparison to the industry PE of 49.48. PB ratio stands at 8.59. Debt to equity is 0.05, which is negligible. Return on equity is a good 20.25%. KEI Industries has maintained a healthy balance sheet with its debt level gradually reducing over the years. An important factor which needs to be noted. Right, if you check the stock performance in the last 1 year, the stock has been down by 10%, whereas over a period of 5 years, the stock has grown nearly 800%. Now, coming to an important talking point, which has been the center of all discussions surrounding companies in this sector since yesterday, after Ultratech announced its entry in this business. Right now, how does KEI stack up against its competitors? And what will be the effect of Ultratech's entry? Well, KEI faces stiff competition from players like Polycab, Finolex, Havels, to name a few. The industry is quite fragmented with no single player holding more than 20% of market share. The big news shaking up the sector is Ultratech Cement's entry in the cables and wires business. This has caused a major sell off in all the stocks in this category, with KEI Industries falling nearly 21% since the news came in yesterday. Is the entry of Ultratech going to create a similar situation like Birla Opus did in the paints industry? Well, Birla entered the paints market with an investment of 10,000 crores in 2021. In a short span of 4 years, Birla Opus has made deep inroads in the market, shaking market leaders like Asian Paints. Now, Ultratech is part of the Aditya Birla Group and brings with it several advantages. First, let us check the distribution network. There is a huge gap when we compare the distribution network of KEI Industries with that of Ultratech, which is going to help it in the cables and wires business as well. Now, KEI network has 30,000 channel partners, 38 branch offices, and its retail segment has around 1,650 distribution partners across India. Now compare it with the behemoth that Ultratech is. Ultratech has a distribution network of 34,500 dealers across the country, 1 lakh 3,000 retailers, 3,900 UBS outlets. It has a fleet of over 60,000 trucks serving more than 30,000 destinations. Now, this is the strong backbone which is going to aid Ultratech in this new business venture it plans to enter into. Ultratech enjoys strong brand recognition and trust in the market. It complements with the rich history of four generations of Birlas in the business. The 1,800 crore rupees investment that Ultratech plans to do in the cables and wires business is kind of a vertical integration for the group. Now, Hindalco, which is another flagship company of Aditya Birla Group, can be a major supplier of copper, which is needed in manufacturing cables and wires. Aditya Birla has a strong financial muscle, with its Ultratech having reserves of upwards of nearly 65,000 crore rupees, as is evident from their balance sheet. If we compare that with KEE, which shows reserves of nearly 3,500 crores, you can see the massive difference in the stage of operations of both the companies. The dynamics of the paint business and the cables and wire business are different. So the entry that Ultratech, this new entry that Ultratech is planning to make, is going to be full of challenges. Now, firstly, the business when it comes to paint is predominantly B2C, whereas the cables and wires business is predominantly B2B, which needs establishing long term relationships with businesses. Next, the cables and wires business requires a lot of technical expertise. It also requires certificates and licensing agreements to enter the business. Next, if you check the market structure, the market is quite fragmented when it comes to the cables and wires business, with not even one company enjoying a market share of more than 20%. right? Product life cycle, if we talk about product life cycle, cables and wires are a product which are built for lifetime usage, whereas paints have a more frequent repurchase cycle. Now, when Birla entered the paints business, it resorted to a disruptive strategy of aggressive pricing. Now, the pricing when it comes to the cables and wires industry is on thin margins of nearly 10 to 15%. So, it will be difficult for Birlas to resort to the same tactics or strategy that they did while they entered the paints business. Also, once the prices are dropped in this industry, it becomes very difficult to increase them again, making price based competition risky. It takes a fair amount of time to establish in this industry. Now, experts suggest that it would take nearly 15 to 20 years of focused efforts of a company to dominate the cables and wires space. Ultratech production is not expected to begin until financial year 2028, with optimum utilization by financial year 3031, giving incumbents ample time to adapt to this new entrant threat. This move by Aditya Birla Group suggests it is positioning itself as a one stop solution for all construction and infrastructure needs. Given its huge cash reserves and the brand equity it enjoys, it can foray into other verticals in the same category. It is already in the construction business with ongoing projects in Mumbai, Pune, and other few cities, right? They also have the backup and the potential to enter into the plumbing and sanitation industry, also electrical equipments, smart home and building technologies, fabricated construction materials, renewable energy solutions, to name a few. While Ultratech has some advantages, such as its existing Ultratech building solution stores and potential raw material synergies with Hindalco, these factors alone are unlikely to overcome the significant challenges of entry in the cables and wires market. The industry's technical nature, fragmented structure, and long term relationship requirements makes it a more difficult sector to disrupt compared to paints. What do analysts say about KEI Industries? Well, Motilal Oswal has given a buy recommendation with a target of 4,780 rupees. UBS also maintains a buy rating with a target of 5,750. Systematics Research has also a buy rating call with a target of 4,943 price. Right? Most analysts see a strong potential but have slightly reduced targets due to increased competition and the ongoing turmoil in the stock markets. To conclude, let us look at some positives and some challenges for KEI Industries. First, we'll concentrate on the positives. Well, the company is part of an industry which has a strong growth outlook. Secondly, it has shown consistent financial performance, which has a growing upward trajectory. Next, the balance sheet also is healthy with its debt gradually reducing year on year basis, and export opportunities are plenty. The order book size of the company stands at nearly 3,500 crore rupees. Coming to challenges, increased competition, especially with the entry of Ultratech. Raw material price of volatility possesses a significant challenge for the company, and potential margin pressures if Ultratech plays out the same strategy as it did in the paints business, then there'll be significant margin pressures not only on KEI Industries but also other companies in this category. Markets plunging to new lows every day. Why should one consider stocks? Well, volatility in the market is normal and it often creates opportunities for long term wealth creation. If you check the current PE ratios in comparison to their 5 and 10 year averages, only mid cap index is trading at a higher PE than its 5 and 10-year average. All other PEs, the Nifty 50, Nifty small cap, Nifty micro cap, have all fallen below their 5 and 10-year averages, which shows that this is a significant opportunity to enter the markets if you buy right and study well before you invest your money. As always, I hope you liked this analysis. If so, please like, share, and subscribe to my channel. And let me know if you want me to analyze any other stock and make a video on it. Before I end, personal finance is personal in nature, so it is different for each individual. Just because one person is buying a stock, please don't go ahead and buy it. First, assess your risk tolerance. Secondly, check your financial goals, seek expert advice, and then take investing decisions. That is the right way to go about it. Until next time, stay safe and goodbye.